Welcome to Perspectives from HSBC. Thanks for joining us. And now, on to today's show.
Welcome to our Perspective series. I'm Richard Bibbey, HSBC's Global Head of Institutional Sales. And I'm delighted to be joined here by Jean Hynes, CEO of Wellington Management. So Jean, thank you very much for being with us.
Thank you for having me on today.
Thank you. And the conversation today is going to be around active management. But before we get into that, I would love to take the opportunity to talk a little bit about you and your career. And I know that you tend to talk about it in three phases. Yes. So could you talk a little bit about those three phases?
Absolutely. So thank you for having me on. So I have been at Wellington for almost 34 years. I came to Wellington Management right out of college. It was a small firm then, less than 300 people, very flat. I started as an administrative assistant. So I'm not sure if you know that about me. I started as an administrative assistant in the research department. That's important to know, in the research department. And when I was graduating from Wellesley College, I didn't grow up in a family that talked about stocks, but I had done an internship, so I knew that I was very interested in the stock market and why stocks went up or they went down. Back in 1991, even the whole concept of the stock market isn't what it is in 2025. And so I luckily found my way to Wellington. And I would say that first decade of being at Wellington was all about becoming a researcher. And, 18 months into working at Wellington, I was asked to go work with Ed Owens, who was my 20-year mentor. And the reason I got recognized is because I did the morning meeting notes once a week. And because I was interested, the administrative assistants did the notes, and because I was interested in the markets, frankly, my notes were better than everyone else's, and that got me noticed. I could write really well. I had an interest in the market, and that got me recognized by Ed. Now, Ed, at the time, was the pharmaceutical and biotech analyst. He had been running Vanguard Healthcare Fund for 8 years. It was $500 million. And he was starting what became our global healthcare all cap and our biotech funds. And he wasn't writing as much. He wasn't writing as much research. So I was just in the right place at the right time. And I'll tell one more story about Ed. I'm in like a 9 on the extrovert scale, and he's a 1 on the introvert scale. And he had walked by my desk for 18 months and never had said hello. And so when they said, "Do you want to go work with Ed?" I said, "No." Like, why would I want to go work with someone? I love the people I was working with, but I sort of was coached that this was a really good opportunity. Ed was a great investor, and it just was really a match made in heaven from day one. So from the first moments that I started working with Ed, I went to every biotech and pharmaceutical meeting with him. And so I grew up in sort of the renaissance of the biotech industry. And so that, as I said, that first decade was like, what does it mean to be a great researcher? What does it mean to get insights, to do deep research on the pharmaceutical and biotech industry? And how do you do that? And what's the process for it? And I just learned from the best. When he retired at the end of 2012, he's probably the most impressive investor that no one's ever heard of, because he had one of the top records of any mutual fund over 25 years.
Fantastic.
Yeah.
And I guess in that era, so the sort of pharmaceuticals and biotech industry, it played a very important part for Wellington then, but it still does today. Yeah. So, how significant is that as part of the strategy of Wellington for today?
Yeah, so we manage up until December 31st, I managed the Vanguard Healthcare Fund, and the last year or so as a co-manager, and I've stepped down, so I only have one job now, being CEO of Wellington, but we manage about $60 billion of healthcare assets, so we're the largest healthcare manager in the world of funds.
And that, you referenced it there.
Yeah.
So in 2020, you took over as CEO.
Yeah.
I'm sure you had a very busy family life as well, and you were managing one of the biggest funds in the world. How were you able to manage that? How were you able to have balance
The third decade of my career was really about leadership.
Yep.
And as I said, in 2012, Ed retired. I became the team leader. The team leader role at Wellington is a really important role because we are managed in the research department by sectors, and research is the core of what we do as a firm. I was managing the Vanguard Healthcare Fund. I was a co-manager on a biotech fund and many hedge funds and our all-cap global healthcare fund. And then in 2014, I became a managing partner. That managing partner role, which is about the governance of our private partnership, fulfilled something in me about leadership, about leadership and talent. It's a very talent-oriented role. So in 2014, I thought I had the best of all worlds. I had my all the number of strategies I ran from Vanguard Healthcare to long-short biotech. I had the managing partner role, and I thought really that's how I would retire. And I was working so closely with the CEO at the time that a couple of things. One, I think he encouraged me, and two, there were many of my skill sets that I could see myself. At first, I couldn't ever see myself being a CEO. I didn't think I had the skill set. But as I worked more closely with him, there's a lot of parallels about making decisions with ambiguity, about taking risks, about connecting dots, and about what the future, because I'm sure we're going to talk about the future of active management. It's about what the future of industries are. Those are all the skill sets that I had accumulated over my long career of being an investor. And so there was a point how did I want to spend my last decade at Wellington? And did I want to continue down that path, or did I want to think, was I the right person to be the CEO for the next period of time? Was I the right steward of our partnership? So we went down, and I was named the CEO in September of 2020, and we did make the decision then for me to keep one money management responsibility, and that was to manage the Vanguard Healthcare Fund, and we had a succession plan for all my other responsibilities, from biotech to 140/40 funds, and we had a number of successors on the healthcare team. And I think in the last 4+ years, what that has allowed me to do is be in the same shoes as our investors, to learn the new skills investors have to evolve. How we invest today is much different than 5 years ago and 10 years ago in terms of the use of technology, how you put either momentum factors or ESG factors or whatever kind of factors you're anticipating, how you manage that in portfolio construction. And so I think it has been a positive that I still manage money while being CEO. It kept me very, very close to the heart of our business. And then the timing of stopping has really been about having a successor who is ready.
Right.
A client who is ready and a successor who is ready.
And so I guess coming back to active management, and we're now in a more uncertain world, both economically and geopolitically. I guess a lot of passive investments are quite concentrated in terms of the risk that they have. So are we entering, as you look at the active space, how do you see the future from here?
Yeah. One of the things, if I take a step back and think about the asset management industry, and I've studying it like I would study the biotech industry or the pharmaceutical industry, the interesting thing about it is that it's a fantastic industry because we earn a fee on assets that grow over time. Now, they don't grow every period. They don't grow every day. They don't grow every month. But if you look over 5, 10, 50, 100 years, and we're going to celebrate our 100th anniversary in 2028, asset prices tend to grow with innovation, productivity, and the world growing. That's a really good industry to be in, but it's also cyclical. So there are these cyclical periods that we have to deal with when we think about the asset management industry. And then what's different about the asset management industry since I've started is that passive has become a bigger part of it and privates have become a bigger part of it. I think there's a role for all of it.
Yep.
I think there's a role for passive. I think there's definitely a role for active. We're a proud active manager. And I think there's a role for privates as well. When you think just holistically about the economy, there is more of the economy is in private companies than in any other period in my career.
Yep.
And then if you think about since the global financial crisis, the amount of lending that happens in the private sphere versus the public banks has also increased dramatically. And so there's just a role. It's like if the role of investing and for individuals and asset owners around the world, in order to get access or exposure and diversification to the whole economy, there's a role for passives, actives, and privates. And maybe the final thing I'll say there is the price of passive has come down to a point, like we might see some, but it's really come down quite a bit. The price of active has also come down. So when you think about the last 15 years, the price of active equities and fixed income have come down to a level that if we can do our job and we can generate, say, even 100 basis points of alpha in an equity fund or 50 basis points in a credit or a bond fund, the compounding effect of that is so powerful over time. That's the role of active management.
And you talked there about the alt space, and the year you became one of the managing partners also coincided with the year that Wellington started with private equity and more recently with private credit. When you reflect on Wellington's approach and you look to the future, how do you see this continuing to evolve? You're
right to go back to 2014, because that's when we started our investment in our private capabilities, starting first with late-stage venture companies. The interesting thing about that started with our public investor who was he was investing in growth companies. And he just recognized that companies were staying private for longer. Now, that's so obvious today in 2025. Everyone, you're like, Jean, everyone knows that. But it was not obvious in 2014. And he took a lot for him to convince our management team at the time to start a private fund. And I'm glad he did. He with the help of many of us who were in the initial funding, as well as a few anchor clients, we started our privates business in 2014, and now we have 8 teams or 8 capabilities across private equity and private debt. I would say for Wellington, one of the things that were our privates capabilities, they're very adjacent to our public capabilities. So I like to say we have sort of, like everyone says, like where do you have the right to win? Where do you have the right? And what I mean by the right to win is, can we attract great talent and can we generate really top tier returns for our clients? It's sort of anything where we can evaluate a security or a credit. And I think there's a lot of places in the private world where that we can do that, and that fits in right with our strategy. And there are plenty of places in the private world where it wouldn't make sense for us to compete. There's, we don't run companies, so, buyout equity probably doesn't make sense for us. And we're not lenders, we're not banks. Right. So there are plenty of areas that really don't make sense for us, and there are plenty of areas where we have a roadmap to continue to attract great talent and expand our capabilities. And so what we're trying to do is think about, we're really focused on our solutions business and how we bring those capabilities to clients. And so that could be in combining our hedge fund investors into a multi-strat fund. Yep. That could be combining our research analysts who manage 140/40 and putting them together. That could be offering a solution to some clients who might want exposure to Japan and don't like the benchmark, and so we might do some active factor, active and passive to create a solution. And I think increasingly it will be about putting our privates capabilities together in a fund or a vehicle that makes it easier or more attractive to go to individuals and go work with our partners to so that more individuals can get access holistically to the economy. And I think increasingly it will also be combining public and privates together in solutions for clients.
Great. So like Wellington, wealth is a huge part of our business. It's a growing one and one that we're investing in significantly. Given the rise of this sector, how is Wellington evolving and adapting?
So if you go back in our long history, we were once one company with Vanguard, and there was a separation, let's say in the 1970s, just about 50 years ago, and we became very focused on investment management for a fee, and Vanguard went and became what they are today with the distribution of mutual funds and eventually with ETFs and passive. And right now, they're our largest client and we're their largest sub-advisor. And I'm just telling you that story is because of the history there, we became extremely focused on investing for a fee, and that led us down really focusing on institutional clients. About 15 years ago, we were looking for great partners like Vanguard in Europe and Asia, and they don't really exist. They, not uniformly. And so it was clear to us that in order to offer our investment content, which is who we are at the heart, we had to have funds, and we had to have a funds business. And so we've spent the last not quite 15 years really building that fund business. And so that allows us to sell our content or partner our content with firms like at HSBC to offer that content to the wealth market. And when you think about the wealth market around the world, it's anywhere from individuals all the way up to ultra high net worth individuals in the continuum of retirement and savings. And so what we're doing as a firm is making sure that we're great partners. And what's new for us would be a brand. We have our name. Most people don't know our name. And so we're working hard on bringing the Wellington brand, the quality of the Wellington brand. That means more marketing. It means working with our clients in different ways. It means vehicles and new ways of bringing that content. And so that's a big investment we're making around the globe.
Where do you see Wellington going over the next 5 years?
Well, number one, there are some things that will be true and some things that I think will evolve. I think that the hallmark of Wellington over my 34 years is that we've constantly evolved our capabilities, while what's constant is the client fiduciary, the culture, the shared values. That part of it has to stay constant. Everything else we can evolve, like everything else, and so I would say, I wouldn't say 5 years. By the time I pass the stewardship on to the next person, I would say I would like to see us just be number one, generating top tier returns in all of our asset capabilities. Because if we do that, then we will have done really very good job for our client. And at its core, our mission and purpose is to help our clients, whether they are individuals in Hong Kong or London, or they're firefighters or teachers or people saving for retirement. If we can help them with their savings, with their ability to help their citizens, then we will be doing our job. So that's like number one. It's like table stakes. And so we have to constantly evolve our investment capabilities and how our investors evolve individually as well, because the market structure is constantly evolving. So that's our number one priority, and it should always be our number one priority. I think the second part of our priority is to continue to expand in two areas where we have presence in, but I suspect will be larger, and that would be in our privates business and in our hedge fund business. And we are, if we can launch vehicles that are like a multi-strat hedge fund, which we are in the process, and then if we could eventually launch evergreen funds with our private capabilities, I think that just allows us to continue to attract great talent for vehicles like that. So I think vehicles will become more important, and back to solutions for putting our capabilities together will also become more important in the next 5 years. So those are a few that I'm focused on.
Great. And you talked there at some point about handing the baton on. I hope it's not for many years.
Yeah.
But when that eventuality happens, what would you like your legacy at Wellington to be?
What I would like people to say about me, and I'm not a big person about legacy, but really it's this concept of stewardship. Like, will I have accomplished things during my tenure, this decade of the 2020s, that will make Wellington be around for another 100 years? We're going to reach our 100-year anniversary. Will I have done things to increase our position in wealth, to increase our position in privates, for example, to have made our investment performance better, so that we can continue to pass on this great franchise?
Great. It's inspirational to hear the enthusiasm. So final question for me, and I think it would be remiss not to talk about the transformational technology that is upon us with generative AI and the likes. How is Wellington thinking about this, both from an investment lens, but also from an operational one?
Yeah, I will say we have on our operations and infrastructure side, all different kinds of ways of doing reporting, client books, how we interact with clients, seeing use cases and seeing progress. I think on our client side, really how to serve our clients better. Like, we have a trove of data now. We use Salesforce. That trove of data, how do we really utilize that? And that could be as we interact with clients. It could be as we interact with financial advisors in conjunction with our partners. How do we use all of that? I'm not going to say most importantly, but I do think most importantly, it's how does it make us better investors? And one of the things about Wellington is that we have 20,000 company visits a year. We have that breadth of capabilities. We have a lot of data. We have a lot of information about meeting companies. We have all our research notes. And so we've really spent the past year creating the data lake. Yep. And that means, putting our own data in there. Eventually you could put company transcripts in there. You could put expert transcripts in there. And so we're really close to having that available to our investors as a way to query. Like, for instance, you could say someone's researching something, tell me, which companies have talked about price deflation. And like that, instead of the human brain can't connect that no matter how much they read. So that could really help our research process. Yeah. And I think the next stage for us is how do we combine that with a research agent to really help and augment our investors in their research process. Because so much of what we do as investors, and I'll tell you, I just stopped investing December 31st, and my biggest observation about that is the next day you're like, oh my God, I have so much time. Really, you have so much. The job of an investor is this constant accumulation of knowledge that you layer on and layer on and layer on. And so at some point down the line, you may use that piece of knowledge to connect a dot. And so how do we use generative AI? But I was never able to consume all the information I needed. I just consumed enough to be able to do my job well. And so you could imagine that generative AI can really augment that skill set. And so we're just working really hard on the tools that will help our investors. And we have a lot of interested investors in this. And so hopefully a year from now, we'll have many, many more use cases.
It's the Gene Bot of 91,
exactly.
Recently graduated from Wellesley,
exactly.
Writing all those reports.
Exactly.
Brilliant.
Thank God that the bot wasn't available in 1990.
Look, thank you so much for joining us today and sharing your perspectives. It's been, fantastic and so enjoyable.
Thank you so much.
Thank you.
Thank you for joining us for this episode of Perspectives. Make sure you're subscribed to HSBC Global Viewpoint to stay connected